Hi, and welcome everyone to this late afternoon session. Thank you for joining us today. So during this session, we'll cover the Treasury transformation that Nord Anglia Education has been through. My name's Brigitte Ageria. I'm a partner in the Treasury advisory group within Zanders, and over the last one and a half years, I've had the pleasure of working together with the Nord Anglia team during this Treasury transformation and seeing firsthand the growth journey that Nord Anglia has been through. It's now operating over 80 schools internationally, and obviously with the challenges that brings and the global footprint, it's been an impressive journey, but that also places quite a lot of challenges from a Treasury perspective as well. So as a result of that, Treasury also needed to change and evolve to be in a good position to support the business. So I'm really pleased that we have Anthony Lang today. Anthony's the head of corporate finance and treasury in Nord Anglia Education. Yep. So you'll take us through the journey that you've been on. Thank you.
Thank you, Brigitte. So good afternoon, everyone. It's a pleasure to be here with you today. In this session, I'll be sharing my insights on Nord Anglia Education's transformation journey, one shaped by rapid business growth and geographic expansion. These drivers underpin the compelling case for transformation across our finance and treasury functions and have started to reshape our operating model as we step into our next investment cycle. So, for those that don't know who we are, and if you didn't know this, we are one of the largest private equity-backed companies that few people have ever heard of. We are the world's leading international schools organization, which has been backed by Barings Private Equity Asia, now EQT, since 2008. We operate more than 80 kindergarten to year 12 schools, that's K-12, shorthand, across 4 continents, spanning 37 jurisdictions and 14 time zones. We are the single largest global investment for an Asian PE platform, but we are backed with global investors including CPP, Mubadala, Dubai Holdings, and Neuberger Berman. We have leveraged common technology systems and attracted world-class partners like MIT, Boston College, Juilliard, and UNICEF to co-create our education programs and to innovate through educational research partnerships in areas such as metacognition. Yet despite our scale, we remain deeply committed to preserving the local identities of our schools for their communities. That balance between global scale and local presence is a part of our success, but it also introduced complexity when we delivered our transformation. Now let me offer you up a short video that hopefully provides some added context into who we are. And no, for full disclosure, I wasn't asked by my marketing team to recruit prospective parents, for those of you who have children in that age range. This is where we have a technical mishap. Sorry to spoil the rest of the presentation. Yes, by all means, please cover your eyes. Turn away. Okay, so hopefully that gives you a bit more context with who Nord Anglia is. But just with regards to a bit of our history, whilst we were founded in 1972, our current growth trajectory actually began in 2008 when we were taken private. But even back then, we were a modest organisation. The organisation was focused primarily on government education services, and we only operated 6 schools at the time. But Baring saw things that others didn't see at the time, which was the opportunity to grow the K-12 school platform into Asia. And as we fast forward today, we've grown annually at a rate of 22% in terms of student numbers, which now takes us to over 90,000 students across more than 80 schools with 19,000 colleagues. And I think this chart, again, if we go back to this morning's discussion, is kind of representative of the resilience of the business. I think the most recent example for all of us as parents as well is during COVID. For those of us, who had to work, but at the same time had to basically look after our kids. Whilst our campuses were closed, Nord Anglia was open. And I think ultimately that basically demonstrated the resilience of the business, even in difficult times. And despite those global headwinds over that time frame, our growth has been consistent and resilient, underpinned by the favourable market dynamics for paid education, which has translated into $2.5 billion in annual fee collection and more than $700 million in EBITDA and operating cash flow. So I think, to put it into context, I don't think anybody would have thought that you could basically accumulate that amount of financial firepower in a school's organisation. And the growth isn't over. We operate in a large, growing and highly fragmented market with secular tailwinds that continue to drive paid education demand. The key trends of our market are 6 to 7% of expected annual growth until 2030. Education as a service only accounts for 5 to 10% of household expenditure. And with the public education sector being highly under-resourced, demand for the private alternative has been higher at 3% versus the public sector position of 0.5%. However, even as the largest schools group, we only represent 1.5% of the global market. So this presents enormous opportunity, but it also puts us under a huge amount of pressure. Our challenge was to scale responsibly, with the operating model needing to evolve and keep pace with this set of growth opportunities. And that's where the finance and treasury functions had to transform, not only to support the operations, but to be a more proactive partner and become more strategically, financially aware so that it could basically guide the business and the operations to yield better financial outcomes. So why transform? Multinational corporations like us have to deal with unprecedented complexity and volatility. From global expansion to digital disruption to geopolitical volatility, which are the themes that we've talked on today, there is a lot to manage and to navigate. But our transformation was driven by 4 key drivers. Firstly, growth and expansion. Scaling school operations in new countries and existing locations, plus tapping into new market adjacencies like partnerships with MIT and Juilliard, meant we needed a different operational capability set, as well as structures. No longer could we run everything out of one central location. We needed to define how we were going to operate through our regional structures. Secondly, market volatility. Heightened geopolitical risk and market instability have driven interest rates higher for longer, as we all know. This was a particular focus for us as a company and our shareholders, given our $6 billion of external credit and being a sub-investment grade corporate. And then there was also the increasing breadth of currency exposures as we grew and expanded the number of jurisdictions we operated in. Thirdly, digitalization. We had to leverage our data in real time and our systems for faster, smarter decisions in the face of volatile markets. It was no longer about reporting the number of students enrolled and the implied EBITDA that was generated. We need to be more insightful in improving re-enrollment of existing students, enrollment of new students, paving the way for improved cash collection and ultimately improving our working capital cycle with greater precision. The need for real-time data and enhanced analytics could only be achieved with investment in new systems and technologies, not even seen in this very emerging sector. And lastly, strategic finance evolution. Our shareholders focus very much on EBITDA as the principal driver of value. And it is very much about knowing your audience and knowing ultimate stakeholders. However, given our size and scale, managing cash and liquidity more effectively would ultimately drive free cash flows, which would allow us to optimize leverage and ultimately drive longer-term value and sustainable distributions for whichever the outcome may be as we approach the end of our next investment cycle. So we needed to evolve from a back-office role to a strategic influencer and partner supporting decision-making, managing risk, and driving value. So, with a decentralized treasury function, with lots of treasury activities at school level, we needed to look at what the group needed and what we wanted our regions and schools to do. Firstly, we needed to have enhanced cash flow forecasting and analytics to better provide higher quality cash data. This then enabled us to build trust and credibility between functions and regions to enable better collaboration on cash repatriation. And finally, we then needed to empower our treasury function to manage risk and move that activity and responsibility away from schools to better mitigate our geographic complexity. I think that's part of the challenge with acquisition strategies. You need to know what you're acquiring. You need to know what you're integrating. If you don't, you're not able to basically maintain what you wanted to buy. And ultimately, we are very much in a small, medium enterprise world. And ultimately, it's our job to uplift that capability set, but also to understand the challenges of how we help our schools along and bring them into this corporate environment that we want them to basically join. So several hurdles needed to be managed. Firstly, organizational gaps. We had very lean functions, which is not surprising for private equity, for those who have worked in private equity businesses. Lacking an understanding of transformation, which meant our teams weren't equipped to step up and embrace different technologies and adopt new processes. Existing activities were still manual and high volume, with treasury activities focused on processing and reporting, as opposed to analyzing and proactively challenging and influencing the business to achieve better financial outcomes. Secondly, limited digitalization. In most cases, the schools that we acquired did not have the need for enterprise-level solutions. No ERP, no digital planning tools, and by the same token, no treasury technology for liquidity management and forecasting. And as a byproduct of the acquisitions, we also tended to accumulate different local banking relationships with no ability to centrally monitor real-time liquidity at school level. So there was a great need to professionalize the regions and schools so cash and liquidity could be used to better drive long-term value. Thirdly, lack of active risk management. Whilst finance was driving EBITDA, there was insufficient understanding of how a school's EBITDA converted into cash, given not all schools had the same operating characteristics. For example, different customer demographics and different payer types drove different school working capital cycles. Without sufficient analytical capabilities, we were unable to proactively manage and plan internal liquidity and mitigate potential funding pressures. Cash was manually centralized, which may be familiar to some, as and when available to send up to us centrally, with an ever-increasing complexity to repatriate due to the increased tax and legal burdens with the increasing number of jurisdictions. In addition, the risk of increased FX pairings, as we started to basically move from 15 countries in the last 7 years to now 37. That amplified the volatility in conjunction with the leverage levels that we had. And lastly, governance and controls. As we move to a less centralized operating structure, with oversight devolved to regions, we need to change in our governance and our control environment, together with different accountabilities. But this required a new treasury policy to reflect our revised operating structure, as well as a formal RACI, and updated processes to ensure we were clear on what was driven centrally versus what was driven regionally. The challenge was compounded also by DOAs that also needed to be updated to empower regions with the appropriate authorities to manage and be more accountable for their financial operations. So we weren't short on ambition, but we were short on infrastructure, capability, and alignment. So what did we deliver? With a demanding set of stakeholders who were very much focused on delivery, we had to act at pace, but being cost-conscious at the same time. Additionally, transformation was not an area that was fully understood by the stakeholders, so investing time up front to allow them to understand, increase their knowledge, was also required. All of this culminated in a demanding delivery schedule in just over 18 months, with additional support required from external consultants and some Treasury specialists to temporarily fill the capability gaps that we had. But they also had a solid appreciation for transformation challenges and change management. Change management in particular was very important, as we not only needed to change the culture, but we also needed to uplift the organization's understanding of cash and liquidity management, which was critical for our future growth, bringing not only regions on the journey, but also other functional areas such as IT, legal, and COSEC, who needed to appreciate that change was also required in their own operating models. Now let's start with where we got to. Better connectivity. It was amazing that the growth we had, there was still a lack of appreciation for Treasury technology. With our increased size, we had a very decentralized banking environment with 90 banking relationships. So that was pretty much, as we acquired each school, we actually picked up a banking relationship at the same time. And you can imagine trying to basically manage something so decentralized, relying on your schools to basically manage that from a controls perspective, very, very challenging as well. So the first thing we needed to implement was the TMS, and in short order, we were connected with 80% of our cash resources on a real-time basis. Centrally, we're now in a position to proactively challenge schools who had historically managed their own liquidity and force them to have a groupthink mindset, with centralization of cash being a benefit for all schools. This resulted in reduced hoarding of cash by schools, balance of schools having greater trust that liquidity would be made available, lowering our overall costs of funding as a result of more effective cash centralization and optimized debt financing. Then there was improved planning, and I think we talked about cash forecasting, liquidity planning. All schools moved their cash forecasting from Excel into our enterprise planning tool, forcing the business to have greater focus on cash alongside EBITDA. And if you remember, one of the things I talked about earlier was about more accountability. By putting the actual numbers in the system, it actually held accountable not only the finance function, but it also held accountable the principals, as well as holding accountable the regional finance team and regional operations team. But it wasn't without its challenges. We needed to work with the regional teams and spend time with our schools, because they were each like an individual business unit, to get them comfortable with cash so that we could move to a world where we had more reliable and consistent planning data that would enable us to plan for expansion in the schools, but also to effectively support our further growth for M&A. But at the same time, we also needed a realignment of our organization. I've talked about the fact that we are historically a centrally run team, but we needed to basically push that out to our regions. So team functionality had remained static for almost a decade, as did the ways of working with other functions. So we got teams to start engaging with clearer races, as opposed to just collaborating without accountability. And with systems and new processes, this provided the catalyst to change workflows and the types of activities to be focused on by financial control, tax, legal, and COSEC. This also gave us the impetus to highlight gaps in our new process that required additional regional treasury capabilities that would be responsible for regional and school liquidity management. And with new systems in place, the IT function was required to enlarge the support model to cover the treasury environment, which is not something they proactively thought about until now. And I think this is one of the most important things about any transformation. It's not just about bringing your teams with you. You need to bring the organization. Because as you work in a larger organization, you work in a matrix function. And you can't do all of the things that are there in terms of specialisms without those other functional areas. And finally, I think this is the thing that we all in the Treasury world want our business to focus on. It's risk management. Given our size and scale, we needed to be more proactive in managing our financial risk and doing it in a more systematic way. By integrating our FX and money market solutions through the TMS, along with better connectivity, improved planning, and the organization's understanding of Treasury, we were able to generate more than $3 million of interest income within the first 6 months of operation. And on average, we had a 7 basis point savings on our FX transactions. So, just some final thoughts. Transformation of finance and Treasury is not just a one-time project. It's a mindset change that is required, not only from within finance and Treasury, but with growth, we need to change the mindset across other functions and the business itself. Upskilling your teams and technology coupled with mindset change encourages confidence and belief in something that can be unsettling and ambiguous. Showing and explaining to your teams the opportunity will make it easier for them to understand transition, but also give them the opportunity to see what else they can do. And finally, with greater uncertainty in our markets and the economic outlook, finance and Treasury must continuously evolve with those they work with. Shifting from transactional to strategic is at the heart of any transformation. And we must take it upon ourselves not just to deliver for the business, but to get the business to have a better appreciation for the financial risk they take on so they can make better informed decisions. Thank you very much.
So thanks, Anthony, for that. Really interesting journey that you've been on. Obviously, you touched on the rapid growth and the large number of schools that you've acquired during a short space of time. Now, given that many of the schools have traditionally operated individually, in some cases also having some principals that are ultimately responsible for the full breadth of the finance activities as well as Treasury-related activities.
Yep.
Obviously, as part of this transformation, you also had to drive centralization. So not too dissimilar with a number of corporate treasurers that are having to deal with a very decentralized organization. How did you look to strategically drive centralization and also get that buy-in from those local schools as well? Because that was also a big part of getting everyone on board.
Yeah. Look, I mean, it was a challenge. This is not a mature sector, right? This is, we were dealing with very much, your local head teacher, along with their teams. We're very much focusing on educating. So trying to tell them they're part of a big organization, that's great, because we can provide them with a lot of the commercial benefits. But at the same time, there's a lot of demand on them in terms of all of the other requirements a big organization requires. The additional reporting, the additional governance that's required. And that's not something that necessarily a school focuses on. So we had to spend a lot of time working with our regions to actually find the right approach to the schools. What was it that effectively they would benefit from? And this shouldn't be surprising as parents. You want your kids to have the best outcomes possible. But to do that, they've got to have the best facilities. They've got to have the best resources available to them and the best teaching. And I think for us, the promise of further investment, further opportunities to partner with the likes of MIT and Juilliard as part of that education offering basically meant that, when we were then starting to talk about how we needed that cash back, there was something in return. They weren't, basically getting the typical one-liner of you need to send your cash up. There was a benefit and a resulting that they saw for their students and also for the parents and the local community. So communication was one the most important thing. I think the second thing here as well is not trying to touch the schools. We are a B2C business ultimately. I think there can be a challenge when people say that Treasury is all about cash. Well, where does that stop? You know, does it stop where we're effectively just managing the external debt financing, or does it go to the very heart of actually collecting tuition fees from our families? And we took a view here that we are very much there to serve the schools, and it was at the school level that we focus our attention on. And therefore, you know, in terms of actually touching the day-to-day, we needed to minimize the day-to-day impact of the Treasury Transformation Program, where we're effectively thinking about bank accounts, as simple as that. We don't want to impact the bank accounts for the parents. That is a massive change issue for schools. And therefore, as a consequence, why basically tell parents that the new bank account's changing? But what we've been doing is basically working on all the back-end infrastructure, the cash management structures, the TMS that will effectively be used to manage that liquidity, give the right tools and the right structures to the regional teams who will then basically provide that local banking service to the schools. And that is where we're headed. We want to basically be an in-house bank for our schools. So very much the case, communication is the first point, but also second point is understanding and ensuring that you're not impacting the day-to-day business in such a way where that business is not necessarily fully aware of what it is you do. Keep it very much focused on what you're good at, and they'll focus on what they're good at.
It's always a fine balance to strike, isn't it?
When
you're trying to drive through change, and obviously change management is a big part of that. So obviously there's the part of managing the businesses, the local businesses and local schools, but obviously there's the other aspect of it in terms of, you know, you're operating within a private equity backed business, and that presents its unique challenges as well as opportunities. What would you say were some of the critical factors that meant that you could secure the investment that was required, and also the buy-in also to embark on this treasury transformation journey? I think a lot of corporate treasurers also, you know, they want to see through a transformation, but it's about making the case for it as well.
Yeah, look, I think, again, it's a different stakeholder group, but again, communication and the right narrative is super important. I think, again, our stakeholder group has been with us since 2008, and they continue to support us in the latest round of funding. But it was very much a case of how can we, as a function and as an area, deliver more value? Because I think there is a view in the world where private equity are very much focused on long-term value. But at the same time, unlike a ordinary corporate where you focus on going concern and how you're going to basically ensure that, you know, you will be here for the next 20, 30 years, private equity have a shorter time frame in terms of their investment cycle. And therefore, when you think about what they want and how they see Treasury, they see it still very much as an operational function. It's just a given. And I actually don't see it as an area that can add more value, except for the fact that the value that they do see is when we start thinking about cash. Moving the agenda away from focusing valuation on EBITDA and EBITDA multiple, getting them to start thinking about liquidity as effectively a friend of value. And why is that? Because that liquidity is there to ultimately manage the leverage that they want to take on. They are trying to drive growth. That is their number one focus. And to do that, you either do it through equity, which usually only appears once in the cycle, or predominantly through leveraging up the business to grow. And by basically demonstrating to them that, one, we were going to provide them with more effective liquidity access, not just externally from the third-party market, but also as we've got bigger, we've got more free cash flow. That free cash flow now can buy us multiple schools, where back in 10 years ago, we could maybe buy one small school. So that in itself enables them to actually understand the value of the transformation program. But at the same time, they're also very conscious of how much we do spend. I think the other aspect here is actually making people understand in private equity that versus other functions, we're not just a cost center. We can actually drive value, we can drive real savings. And you can see that when you're talking about market risk, we are in a higher risk environment. And therefore, as a consequence of that, we need to demonstrate what that value means for the business in terms of cash savings, in terms of, again, liquidity management, when we can actually generate positive surplus income on our liquidity buffer. Because that was another challenge, right? Private equity would prefer you not to basically have so much liquidity available, because as far as they're concerned, that's just dead return. You're not earning enough. But when we were growing, we didn't even have time to basically think about putting in money market, higher return, let alone thinking about crypto and stablecoin as a way to basically drive value like some corporates are doing now. But as a consequence of that, they also understood the value that this project would actually yield. And that actually is going to be the basis for further opportunities as we think about what we do going forward and how we can enhance those returns that will basically support further investment in our transformation.
Indeed. Now, given the impressive journey that you've been on over a short period of time and the progress that you've made, both when it comes to cash visibility as well as the cost savings that you've achieved, what would you say is next for Nord Anglia, and where you want the treasury function to be?
Look, I think I touched on the fact that we want to be an in-house bank. I don't think we believe that we want to be B2B2C. I think the treasury function, given where the sector is at the moment, is probably okay with understanding that we can provide them with all the services that they never had to deal with. If you think about it, we acquire these schools, they never had to repatriate, right? These schools would effectively keep the funding for themselves, accumulate huge surpluses, but not know what to do with it. We're now basically saying to them that you now need to basically utilize that surplus in a bigger and better way, such as partnerships, such as new research that effectively will keep our product relevant. I've talked about metacognition. I'm not sure if anybody knows what metacognition is. Metacognition is teaching about how one thinks when they think. That sounds like an odd concept, but if you actually think about education, over the years it's changed. It's that research of how we basically teach, how we basically get our kids to think. That basically is very different today than it was 20, 30 years ago, and it's going to be very different in 20 years' time, and you've got to basically stay relevant. And I think I heard one of the earlier speakers in the other panel discussions talk about knowing the business. That is the requirement of Treasury going forward. We have to understand the business. It's not just about is there sufficient liquidity. You need to almost basically be able to talk to the business and actually explain why that liquidity needs to be there. So moving towards an in-house bank structure, yes, we want to basically understand our client better, the school, which basically means that we will get more embedded in what we do for our regional teams. But to do that, we also need to basically scale up. We also need to give them the right tools. And AI will be part of that journey. Because I don't think we have the luxury of time to basically go through the process of trying to educate and bring this sector up to a level where we have cash managers all over the place. The way we're going to do the scale up is effectively through technology. We're going to do that through AI tools. And ultimately, as we've gone through this journey of enhancing cash flow data capture, we're basically setting the structure in place so that all of that manual work that is currently done by your local finance bursar in the school, that will effectively be taken away. Because we think about things as a journey and customer engagement when we engage with our parents, because we have contracting. We also basically have the enrollment and the engagement, as well as effectively the collection and the invoicing. All of that is one whole process map that we need to basically automate. And as we do that, we basically can use AI to basically understand each of the customer demographics. And you never know, with that, it allows you to basically then think about what else do my customers want? What other ancillaries do we basically think, will be beneficial for them? Because when we think about, the opportunities we want to give the children, whether it's effectively extracurricular activities, field trips, what other things can we offer beyond that? So for that, we're needing to basically get closer to them, and that will be the next part of the transformation journey.
Indeed, and sometimes it's about just getting the foundations in place, right, before
you can embark on
run,
that massive change. Yes, absolutely.
Walk before you can run, indeed. I just wanted to pause for a second just to see if we had any questions from the audience.
Everybody was ready for happy hour.
Indeed. Perhaps before we wrap up, just a final question.
Yep.
Obviously, given your extensive experience of working in treasury functions, both in corporates that have PE-backed as well as listed companies such as the likes of Tesco and Thomas Cook previously, what would you see as being the key kind of differences in terms of expectations of treasury from that perspective?
Yeah, look, I think, I've worked in both the public and private arena, public investment grade, public sub-investment grade, private sub-investment grade. I think that each have their own objectives, their own requirements. I think in the public context, we are there to ensure the longevity of the organisation as a priority. And therefore, when we think about managing risk, we think about it in a very different way from private corporates who spend a bit more time focusing on value for the investment cycle they're in. So I think, when you then basically are contended with that, you have to basically think about the solution in a slightly different way. But ultimately, when we then look at where private equity is today, we've talked about the fact that they have short investment cycles, 5 years. But if you think about the challenges that sector's now going over, the fact that secondary buyouts are not happening because of value expectation challenges, and now that you've got private equity holding for longer, you start to see that, as we saw with Barings Private Equity and EQT, that if you start holding for longer, you start to think about the business in a different way. You start to invest in different ways. And I think, what we'll see with private equity in the next 5 to 10 years is this change, because a lot of them will have already hold some of their assets for already more than 10 years. They'll maybe have to hold them for another 10 years. And if they're going to look to monetize at some point in time, they'll need to basically invest in their functional areas. And those functional areas will be focused on cash, and that's where Treasury will play an important role.
Indeed. Well, thank you all for joining us today. And Anthony, a big thank you for taking us through your Treasury transformation journey, and
Sure.
best of luck in the next steps.
Thank you.